With many prospects of an upcoming recession, investors are often left clueless about what to do, some even backing down from the market entirely. But is that really the best thing to do? True. Investing is akin to navigating a complex terrain, filled with unpredictable twists and turns. Benjamin Graham's seminal work, The Intelligent Investor, serves as a reliable compass for those venturing into the world of financial markets. Let's embark on a brief exploration of the 5 key takeaways from this timeless classic. Note, this is just a summary of the book. I highly recommend you to check out the full book in the link in the description for a more in-depth understanding. Even better, be sure to smash that like button. Subscribe and turn on the notification bell to stay up to date with our newest videos. 1. Meet Mr. Market. In the dynamic realm of investing, Graham introduces the concept of Mr. Market, a metaphorical figure representing the market's unpredictable and emotional nature. Picture Mr. Market as a friend with extreme mood swings. Some days he's euphoric, convinced that everything is golden. Other days he's a pessimist, declaring the end of the world. This emotional roller coaster mirrors the stock market's erratic behavior, influenced by factors ranging from economic indicators to global events. Graham advises investors to approach Mr. Market with a level head, treating his daily mood swings as noise rather than signals for action. The key is not to let market fluctuations dictate investment decisions. Instead, focus on the intrinsic value of the companies you're investing in. Understanding Mr. Market's capricious nature is crucial for maintaining emotional discipline, a recurring theme in Graham's philosophy. By envisioning the market as a moody friend, investors are encouraged to adopt a long-term perspective, resisting the urge to succumb to short-term market sentiments. Picture this: if you know that an apple costs $5, would you buy it if someone else is selling it for 10? 2. Defensive and enterprising investors. Within the vast landscape of investors, Graham categorizes them into 2 distinct types: the defensive and the enterprising. The defensive investor, likened to a turtle protecting its shell, is risk-averse and prioritizes capital preservation. This investor gravitates towards large, established companies with a history of stability and consistent earnings. On the other hand, the enterprising investor, akin to a hawk soaring above the market, seeks opportunities in undervalued stocks. This investor is willing to take calculated risks for potentially higher returns. Graham identifies the enterprising investor as one who profits from the market's frequent misevaluations, emphasizing the importance of disciplined research and analysis. In understanding these investor archetypes, Graham encourages individuals to reflect on their risk tolerance, investment goals, and personal inclinations. The defensive investor provides a stable foundation, while the enterprising investor introduces an element of dynamic exploration and potential growth. 3. Fundamental analysis. Imagine navigating a bustling marketplace, each stall representing a potential investment. Graham urges investors to approach the market with the same discernment they would use when buying goods. Before investing in a stock, one must understand the fundamental aspects of the underlying business. Graham's analogy extends to viewing a company as a house you're considering buying. Just as you wouldn't purchase a house without inspecting its foundation and assessing its overall condition, investing in a company requires a comprehensive examination of its financial health, management team, competitive position, and future prospects. Financial statements are the blueprints that unveil a company's financial well-being. The income statement reveals its earnings, the balance sheet outlines assets and liabilities, and the cash flow statement assesses its ability to generate cash. Graham emphasizes that understanding a company's management is crucial, drawing parallels to entrusting a chef with the preparation of a gourmet meal. The competitive landscape serves as the neighborhood where the company operates. Investors need to be aware of competitors, their strengths, and how well the company stands against them. Prospects, akin to the potential appreciation of a house's value, require evaluating a company's growth potential, industry trends, and potential challenges. Graham's advice transcends analyzing fundamentals. He underscores the importance of investing only in businesses one understands. This aligns with the principle of avoiding investments in industries or companies that are beyond one's comprehension, promoting a strategy grounded in knowledge and understanding. Now let's take a look at some strategies of how a defensive investor and an enterprising investor can pick stocks. Stock selection for the defensive investor. Graham provides specific criteria for the selection of stocks suitable for the defensive investor. These criteria include an adequate size of the enterprise, a sufficiently strong financial condition, earnings stability, a dividend record, earnings growth, a moderate price/earnings ratio, and a moderate ratio of price to assets. These guidelines serve as a checklist for defensive investors, aligning with their emphasis on stability and capital preservation. Stock selection for the enterprising investor. For the enterprising investor, Graham recommends exploring stocks trading at 52-week lows. This strategy directs investors towards stocks and industries that are currently undervalued or unloved by the market. By focusing on stocks with perceived negative sentiment, the enterprising investor aims to uncover hidden gems and capitalize on potential turnarounds. Graham also highlights the commonalities among successful investing professionals: discipline and consistency. These professionals maintain a steadfast approach, resisting the temptation to deviate from their strategies even when they are out of favor. Additionally, he notes that successful investors prioritize thinking deeply about their strategies and pay minimal attention to short-term market fluctuations. 4. Risk management and diversification. Investing, Graham suggests, is akin to crossing a bridge, a journey that investors undertake with the primary goal of reaching the other side safely and with their belongings intact. However, like bridges, investments come with inherent risks. Graham places significant emphasis on risk management and diversification as essential elements for a successful investment journey. Imagine crossing a suspension bridge. While impressive, it can be shaky and vulnerable to strong winds. To ensure a safe passage, you wouldn't concentrate all your weight on one section of the bridge. Instead, you'd distribute your weight evenly across the entire structure. This analogy mirrors the concept of diversification in investing. Diversification is portrayed as spreading one's weight across multiple bridges. This strategic approach mitigates the risk associated with concentrating investments in a single asset class, industry, or geographical region. In a diversified portfolio, different assets act as bridges, and the risk is distributed, providing a more balanced and resilient investment strategy. Graham suggests thinking of diversification as you would a buffet. Instead of filling your plate with just one dish, you sample a variety of options, creating a balanced meal that satisfies your taste buds and nutritional needs. Similarly, a diversified portfolio offers a balance of risk and potential returns, aligning with individual investment goals and risk tolerance. Diversification acts as a shield, enabling investors to weather market storms and emerge with their wealth intact. 5. Margin of safety. Negotiating for a house serves as a poignant analogy for understanding the concept of a margin of safety, a fundamental pillar of Graham's investment philosophy. Consider finding the perfect house with a slightly steep price tag. Recognizing its true value, you offer a lower price, creating a buffer against potential losses. This negotiation strategy parallels the idea of buying stocks below their intrinsic value. Doing this provides room for mistakes, thus minimizing risks, as making zero mistakes is virtually impossible in the stock market. Graham compares the margin of safety to a castle wall, a robust defense against market fluctuations. A thick wall withstands sieges and storms, while a thin wall crumbles. Bonus: lifelong learning. Since you have made it this far into the video, I have a bonus point for you, and that is lifelong learning. Benjamin Graham emphasized the market's pendulum swings, requiring continuous adaptation through knowledge acquisition. The market's complexity, shaped by trends, technology, and economics, necessitates perpetual learning. Investors must stay informed about emerging trends, conduct detailed company analyses, grasp economic indicators, explore diverse investment strategies, and engage in continuous research. In essence, lifelong learning serves as the investor's compass, guiding them through the dynamic market landscape and empowering them to make informed decisions for sustained success. It is an investment in their financial future, fostering adaptability in the unpredictable world of investing. As investors navigate the market seas, lifelong learning becomes the wind in their sails, propelling them toward a horizon of enduring financial achievement. Amid recession concerns, Benjamin Graham's The Intelligent Investor offers essential guidance. The 5 key takeaways cover navigating Mr.Market's volatility, understanding investor types, emphasizing fundamental analysis, specific stock selection criteria, and highlighting risk management strategies. Analogies like bridges, buffets, and negotiation strategies illustrate the importance of diversification, the margin of safety, and lifelong learning in navigating the dynamic market landscape. Graham's principles serve as a compass for investors seeking enduring financial success. But one question is still left unanswered: how do we actually analyze a financial statement and delve into the inner health of a company?